Hi there, welcome to Kneppy Invest and welcome to another answer and reply video. I've chosen about 15, 17 of your questions and comments to answer or reply to in or to the best of my ability. And I wouldn't say I've chosen these particular comments and questions at random. They were selected for various reasons. And one of, or a few of these questions I've chosen because they put me outside my comfort zone. In particular, one question. And I think it is quite helpful and wise to, on occasion, get outside of your comfort zone because that is a way to grow, not only as a human being, but also as an investor. And over time, if you put yourself continually outside of your comfort zone actually grows and expands, and you just become more comfortable in life itself. And if you never get outside of your comfort zone, you're going to feel really restricted and constricted and quite often not feel comfortable. So, getting outside your comfort zone, I think, is quite wise. And a lot of people don't do that anymore. A lot of people just want to stay in their comfort zone, not grow as a human being. And that is something I don't want to get into, don't want to enter, to be too comfortable in life, that sort of thing. Anyway, this is not a video on philosophy. I wouldn't call myself a philosopher at all. I'm going to answer some of your questions to the best of my ability, and some of your comments as well. Now, Just James Dean 6 days ago wrote, capital expenditure should immediately be deducted off profit and reflected in lower return on equity. That would definitely lower return on equity. Probably my only pushback against this is, in a way, capital expenditure is already deducted off profit through the way of depreciation. Yeah, depreciation is that sort of thing. They are, because capital expenditure is your, say, buying a big tractor, and over time you depreciate the worth of that tractor off your financial statements. So in a way, that is depreciation. It's deducting capital expenditure off your profit. Another thing I probably would say is a lot of companies that are heavily or highly intensive, capital expenditure intensive, however you say that, it can be quite lumpy. Capital expenditure can be quite lumpy. And I think Qantas is a great example of this. I don't follow Qantas too much, but I do know there's been some rumblings that they haven't really spent much money on planes over the past decade or so, and they're going to have to spend a lot of money on planes in the future. So I would assume that Qantas is, or their capital expenditure is quite lumpy. In fact, let's have a look. Why not? Let's have a look at Qantas. I'm just guessing, by the way. I've just heard this a few times in passing. Not the sort of company I would ever own unless I'm trading it. I don't think Qantas, because they're highly intensive, by the way, in terms of capital expenditure. If we go to their financials, they should have a capital expenditure line. Really, where should it be? There it is. Well, in fact, you can actually look at depreciation and amortization, and it's well over. It's between $1 billion and $2 billion a year. So that's sort of an insight into how much capital expenditure this company does spend. But if we go to, say, what's a balance sheet? Balance sheet. I've always looked at capital expenditure in cash flow statement. And there it is, capital expenditure in investing activities. And, ooh, yes, okay. So what we'll do is, I'll put this in a chart. So this is the capital expenditure for Qantas over the last 10 years. And you can see definitely there are some periods where it's been quite small, and then some other periods quite large. In fact, the last few years, their capital expenditure has exploded to between 2.5 and $3 billion. Back in 2021, 2022, it was quite small, even 2020, quite small. So we have seen an explosion in capital expenditure for Qantas over the last few years. So, and if you have a look at depreciation and amortization, oh, it's on this right there. It's right there. That's awesome. You can see your depreciation and amortization has been rising. I wouldn't say it's not equal, So there are periods here where depreciation amortization is much greater than capital expenditure, and some periods when it's actually lower. So it's not a like for like, but in a way, capital expenditure and depreciation are linked. I don't think this company would have much amortization, which is sort of depreciation for intangible assets. So in a way, capital expenditure is dictator of profit through depreciation, I suppose, in a way. And definitely, if capital expenditure was dictated of profit, return on equity would be lower. But it's already. So that's. And by the way, I should also mention I am not an accountant. I have taken accounting classes in the past, but we're talking about 30 years ago. So I would not consider myself an accountant. So if there's any accountants out there who would love to rebuttal against anything I've said, I'd love to hear it, because again, I want to learn. I want to grow and learn. And to be honest with you, being wrong is the best way to learn. And anyway, so let's move on to the next question. This is from, I found a way to really do this process much quicker, just do searches. This is a question from Chase M4Z, who actually wrote two of these questions. Hi, Kneppy. Could we have an update on Santos? Please. Since you said please twice, I have decided to answer your question. Not my favorite company in the world at all. In fact, let's have a look, since we've got FinChat open. Santos. I have traded Santos in the past, many years ago, probably 6-7 years ago. They released a quarterly or something, and at this point in time, Santos was an unliked company. They were going through some problems, and all it took was one positive quarterly. I'm not sure if it was a quarterly result or just a bit of an update, and that was a turnaround in the sentiment in this company. This would have been back in 2016, 2017. Anyway, so if you have a look at this particular company, again, it's a mining company. And in my opinion, mining companies are not high quality. They can never be high quality, because their financial success is going to depend on the underlying thing they are mining, or, whatever. So if you just have a look at the revenue for Santos over the last 10 years, you're not going to see what I would love to see, which is revenue increasing through time, although it has been increasing. If you take away that big lump in 2022, we have seen an increase, but we have seen it decrease over the last few years. So honestly, over the last 10 years, it has increased from 2.4 billion up to 5.4 billion. But then you have a look at, we'll have a look at earnings, net income. Yeah, we'll have a look at net income. Here we go. Net income. And yeah, net income has been quite lumpy. In fact, back in 2015, 16, 17, profit for this company was highly negative. So it would have been there. There was definitely a turnaround in Santos sometime back then, and the company became profitable. Some really big profits in 2022, but dropping profits in the last few years. So for me, it all comes back to oil, and oil hasn't really done anything over the last 20 years. We can verify that. Now, the other thing I should mention here is I don't know anything about the future or the potential around Santos. Maybe they have something in the pipeline that I know nothing about, because I don't really follow this company too closely. Now, in fact, I was going to have a look at oil. Here it is, oil. And if you just have a look at the weekly chart for oil, it's just done nothing over a 20-year period. In fact, oil was higher back in 2007, 2008 than it is now. So this is not the chart of something that I would like to own for the long term. Now, maybe you could argue it's just gone through a 20-year period where it's just consolidated. That's it. And maybe we're going to see a massive uptrend in oil over the next decade or so. That could happen. But if it does happen, we'll see in the chart. We'll see in the chart, because at this point in time, oil is doing nothing. And in fact, if you have a look at the daily chart, oil is sort of in a zone where it's sort of in this purple box is a support zone. So this could be a period or a time, maybe now, to take positions in some oil companies just because of where the price of oil is right now. It's at a support zone, and it is fairly low at $67. And Santos, you're going to see something similar in Santos. The share price probably reached a peak in 2018. I'm just guessing here. Not 2018, 2008. Let's have a look. Yep, it reached a peak in 2008, just like the oil price. Share price of Santos, $18. Right now, $6. Share price has dropped 67% from its peak in 2008. So definitely a bit of a correlation between Santos and oil prices. And you can see back in 2014 through to 2016, share price of Santos dropped from $13 all the way down to $2.50. And that was a pretty significant drop, a lot of negative sentiment in this company. And then it turned around back in, looks like 2017. I think I must have traded Santos back. It would have been 2017, definitely now, I remember, because I took profits because I went away on a 2-month trip and I took profits just before I went away because I just wanted to take profits because I was going away. And the share price kept on increasing after that. All the way up to $9. And that was the most recent high. That was a high point in share price of Santos. This was just before COVID-19. Anyway, so that's all I've got when it comes to Santos. It's not a high quality company. The performance of Santos is beholden to the price of oil, simple as that. But oil right now is fairly low, and maybe you could say that Santos could be a good buy. It could be a good buy. I'll say that. Although the daily chart doesn't look that good. Okay, Santos, that's it. Next, we have Supply Network. Supply Network from a motivational Flavio who wanted a deep dive on this particular company. Seems like a high quality company and great for long-term hold. Thanks, Kneppy. Now, for full disclosure purposes, I am a shareholder of this company. It took me ages to become a shareholder of this company. I've been following it for the longest time. And then one day I just said, look, I've just got to buy some shares of this company. Instead of just following it and saying what a great company this is, just buy some shares. And if the share price pull back, I'll just add to my position. And since I bought shares, the share price has gone up 20%, which we have seen time and time again in this company. You wait for a pullback. The pullback never happens. Anyway, so let's have a look. Let's go back to TradingView. Not TradingView, what do you call this? FinChat. Is this a high quality company? So there's quite a few things I look for when determining the quality status, where it fits on the quality spectrum. And so some of the things I look for, do you prefer the black chart or the white chart? Or the black screen or the blue screen? I prefer it. I'm trying to change it. It just won't change. There we go. It just took ages. I personally do prefer the white screen, but someone complained once that you should always look at stuff on black screens for some reason. Oh, geez, what's happening here? It's just frozen. Just refresh. There we go. Okay, so some things I look for when it comes to the quality status of a company is, well, the first thing I look for is revenue growth. This company has seen really good revenue growth over the last 3, 5, 10 years. 10 years, 14.7% per year. Over the last 5 years, 20%. Over the last 3 years, 22.1%. So revenue actually, or the revenue growth is actually expanding at a pretty nice rate. I'm not sure why this is not working. Or maybe it can't. Oh no, I don't think there's any. I was thinking the screen should go down, but it's not happening. And I think the reason behind that is because there's nothing to go down to. Anyway, so first thing I always look at is revenue growth. And the revenue growth for Supply Network is fine. Beautiful growth in revenue. Now, I do prefer revenue per share growth. In FinChat, you don't have that. In Guru Focus, you did. I loved Guru Focus because of that. Unfortunately, Guru Focus was way more expensive than FinChat. So it's one thing I wish we had in FinChat is revenue per share growth. Because who cares about revenue growing if a company is expanding their shares on issue? We've seen that on occasion. A company called, no longer listed, bought out, Tesseract, their revenue was exploding, but because they had done so many acquisitions, the shares on issue had exploded as well. In fact, the shares on issue grew at a greater rate than revenue. So that's why I prefer to look at revenue per share. Now, I don't think Supply Network is expanding their shares on issue all that great, so it probably doesn't really matter in this case. Anyway, so really good growth in revenue. That's the first thing I want to see. Always I have a look at earnings per share growth, and that has expanded as well, which is telling me the margins in this company are growing. So earnings per share over the last 10 years at 18%, 5 years, 32%, over the last 3 years, 28%. And even their dividends have been growing at greater than 20% per year. In fact, over the last 5 years, growing at 34% per year. Not the sort of company you would own if you're income seeking because their yield is only 1.9%. But if they continue this growth, that yield you're going to have on your initial capital is going to grow significantly in 5 to 10 years. In fact, your dividend yield on your initial capital could be as high as 20% within 5 to 10 years. That is a really good investment if you just see dividends growing through time. And even that could be beneficial for income investors. Maybe not now, but in the future. Another thing I will always look at is margins. So gross margins 43.6, and I'll always look to see how margins are increasing. Now, in this case, we don't see it on this page because it's just margins right now, 43.6%, operating margin 16.9%. But just below that, we have return on equity and return on invested capital, return on capital employed, return on assets, 5-year average. Return on equity is at 35.1%. And return on invested capital 22.6%. That is the sort of I call these metrics like efficiency metrics or quality metrics, maybe is a better way. And when you see those sort of numbers, when it comes to return on equity, return on invested capital, that's a sign of a high quality company. So we have all the things, all the metrics screaming high quality company when it comes to supply network. Now onto valuation, P ratio 40.6, a little bit high, and PB or price to book at 12.8. EV, they also have EV to sales, EV to EBITDA, price of free cash flow, EV to gross profit, and they're all a little bit high, but that's sometimes you do have to pay for quality. Another thing I just want to have a look at here is if you just have a look at revenue of this company over the last 10 years, beautiful chart. This is exactly the sort of chart you want to see. In fact, every single year, out of the last 10 years, the revenue has grown. So that's exactly what you want to see. The other thing I like to look at is gross profit margins over the last 10 years. Has that expanded? And I have a feeling it's going to. Yep. So actually it was contracting from 2015 through to 2019. It contracted. But from 2019 through to now, it has expanded back up to 43.6%. Exactly what I want to see. So if you have revenue growing and gross profit margins or any margins growing, you're going to see a greater growth in profit. And that is what we have seen with supply network. So a lot of things moving in the right direction for this company. The other thing I'm just going to mention here is the chart. So you can always look at the chart. So Santos, definitely not a high quality company. But let's have a look at supply networks. Just this is the daily chart. Beautiful chart. Probably support level for this company would be the 100-day moving average. So they have the 25 and 100-day on this. If you have a look at the weekly chart, maybe my only concern would be how far away the price is from the 200-week moving average. Now, the last time the share price of this company hit or reached the 200-week moving average was back in March, April 2020 during the COVID-19, what do you call it? The COVID-19 financial panic. We'll just call it the COVID financial panic. At that point in time, the share price was about $3.44. So we have seen the share price, grow tenfold since that particular time. So we're talking about 5 years ago, the share price of this company has grown tenfold. You can't say that about many companies on the ASX. So this particular chart, the weekly chart, this is a sign of a high quality company. Daily chart is a sign of a high quality company. And there's not much. The only negative thing I've heard analysis say about supply network is liquidity. And I'll be honest with you, I'm not sure that is a bad thing. Anyway, and I don't think liquidity is an issue with this company. If you have a look at trade history, there's plenty of traded. You can easily get in and out of supply network if you have to. There's trading every single day, and there's enough traded. So I think a lot of times when experts complain about liquidity, they're talking from the viewpoint of a large fund. For a large fund, maybe supply network, there's not enough liquidity. And I just ignore when experts say that on, say, AusBiz. Oh, this company doesn't have liquidity. Well, yeah, for a large fund, maybe. But for the individual investor, liquidity is fine. And that's definitely true for supply network. So I bought at $30. Share price has gone up 20% since then. The other thing about supply network is we have seen overall weakness in the market the last few weeks. And look at supply network. No weakness at all. That's a pretty good sign. In fact, the share price is not that far off from the all-time highs. That's a good sign for supply network. So I do have supply network in my super, and I have not even one thought of selling my shares in supply network. Not one, until they give us any sort of justification for selling. And at this point in time, no. That's just my opinion, by the way. Just my opinion. Anyway, so that's supply network from Motivational Flavio. Next on the list is a reverse takeover. This is from Map0v0. KTG to MPW reverse takeover. Thought KTG was a write-off. I did not know about this, so this is all new to me. Metal powder works. So what I usually do in these sort of situations, without even knowing about it, yep, you can see massive rise in share price of Metal Power, and that's the reason behind that is because MPW was Empower, then they delisted or bought out, or maybe they changed the name. And so for some reason, TradingView doesn't understand that sometimes a company can have the same ticker code, not same ticker code can be used by different companies. And the last time MPW was traded was back in May 2020, and that's why we have this period of time here where TradingView says there was trading in this company, Metal Powder, but that's not true. So that's the one negative thing about TradingView. It cannot distinguish between two different companies who have the same ticker code. Anyway, so Metal Power hasn't been trading all that long. And what I'll usually do in these sort of situations is I put this onto my IPO list, and then I just wait to see how this company performs. Now, if you have a look at the announcements, so it's only traded for 4 days. By the way, share price, geez, I don't think that's real. I'm not sure. If you have a look at the announcements, there's a presentation. I have no idea what this company is. Something to do with metals and powder. Maybe they grind down metals into powder and then they work with that. Metal powder works. I have no idea, no idea about this company. So typically, when I do see a new IPO, I will have a quick look at their financials. Is a company profitable? Is a company selling anything? Or is a company just a storage stock? So I have no idea about this company. So a lot of times the first thing I look at is just the most recent financial statements. And they did have the annual report, 31st of December 2024. Oh, they do have KTG reviewed accounts for half year. So that's a different company. So apparently this is a reverse takeover. I don't know. I'm just guessing right now. Metal powders work. A lot of times in the annual report, they will give an overview of what the company does. In fact, here we go. Principal activities. Now, the company did release a presentation. So during the financial year, the principal continuing activities of the consolidated entity consisted of machine and process development, system industrialization, closed loop control system, simplified user interface development, yield productivity and tool design improvements, material portfolio expansion, business development, customer partner engagements. Still don't know what they do. They had a loss, significant change in state of affairs. On December 17, 2024, KTG announced it has entered into binding agreement to acquire 100% of Metal Powder Works. So that does support now or confirm that this was a reverse takeover. Okay, so the other thing I just want to look at here is just the financials. So revenue, how much revenue they have? Not a lot, $770,000 in the year and a loss. So this is a fairly small company. I would say also, I wouldn't say it's an absolute story stock, but there obviously is a bit of a story here. Okay, now let's have a look at their investor presentation. Metal Powder Works. Probably get a better idea of what they do. You could also have a look at their website. I assume they have a website. If they don't, in fact, that would be a concern. Metal Powder Works. It won something. 3D Printing Industry Awards. Okay, so now we're sort of getting indication of what this company does. 3D Printing, Material Company of the Year. Talking about the transaction, the reverse merger or takeover. This company was established in 2017 to develop a non-thermal, computer-controlled mechanical process to manufacture high-quality powders for the existing PM markets and the fast-growing additive manufacturing markets, based in Pittsburgh, Pennsylvania. Well, I am. My family is on my father's side is from Pennsylvania, so there you go. Pennsylvanian proud. Produced 1 to 2 tons of powder, an increase of tenfold from 2022. Current installed capacity of 58 tons, scalable to 230 tons. Copper priority given the existing market, lack of domestic production, and US Navy efforts to modernize. They talk about the technology. Probably that goes over my head. So I was thinking 3D printing, but this looks like they're a little bit different. Additive manufacturing, that sort of thing. Capital structure, shares on issue, 139 million. Markup is 27 million at 20 cents. So share price is already doubled at 40 cents. So it looks like the market does like this reverse takeover. The CEO and CTO. So if you, Mr. Barnes, John Barnes, CEO and Managing Director, 30 plus year in product development in aerospace with Honeywell, Lockheed Martin, Skunkworks, Australia's CSIRO, and Iconic. Interesting. Nice little background there. Yep. And there's a timeline. I do love these sort of presentations. Maybe I'm just lazy, but this is, in a way, this is this company marketing themselves to you and me. So interesting. Metal Powder Works, new company on the ASX, and this is a reverse takeover. Now, I wouldn't be that interested in this company just yet. That's a appropriate word, just yet. I just need to see that their business model is, is working. And that means I need to see revenue growing. And they've just mentioned this on this particular page. Demonstrated revenue growth generation over prior year. So they've grown revenue, or they've doubled revenue. Well, actually, no. It's interesting. I thought that maybe they've doubled revenue, but no. Generated $800,000 revenue in 12 months to December 2023. Generated $400,000 in revenue in 6 months to 30th of June. So they haven't really shown any signs of revenue growth just yet. So this could be a case where it takes a while for me to get interested. Anyway, so new company on the ASX called Metal Powers Works. Thank you for that. Map 040V0. Next on the list is, no, not that one, is the meaning of life. Capstone. So this is from Forest Hill 8462. So this is more philosophy, sort of, but I think it's more biology. By the way, Capstone contract is in Spanish with the Chilean water management agency. I think it's slightly negative. If the meaning of life is to procreate, which I don't agree with, then what about the millions of people like yourself who don't have any? Well, this is really interesting. So when I say the meaning of life is to procreate, I don't necessarily mean humans. I mean, generally, life is just to procreate. And the reason I say that is if you think about life, everything that is living eventually dies. Everything that living eventually dies. That's the definition of life. Eventually, we all die. So that means procreation is really important. And in fact, there are species out there who procreate and then die straight away. It happens all through life. Procreate, then die, which actually gives credence that the whole point of living is to procreate and keep your species going. So to keep your species going. When it comes to humanity, do we have that problem? Do we have to keep our species going? Well, at this point, no. How many people do we have on the planet? 8 billion. We have no problems keeping our species going. Now, I think there is a chance that we're going to have to explore space, grow or move our species into the rest of the solar system and eventually into other solar systems, other galaxies. Well, that's going to take a long time. And I think one of the reasons, I think there's many reasons why birth rates are falling. It's just, I think it's nature saying, well, we don't need you to procreate anymore. I think that desire is leaving a lot of humans. We just don't need to procreate. And a lot of times in the past, the reason people procreated is, and the reason they had 7 or 8 children, firstly, children died because of diseases. Now, we've eradicated most diseases. Unfortunately, diseases are coming back. Measles are coming back. Things we thought were eradicated because we thought were eradicated coming back now because people are unvaccinating. And I think eventually we're going to realize that, our ancestors were really right when it comes to vaccinations. They are really good. It's the reason why people were lining around the blocks and blocks to get vaccinations, because they protected children from dying at an early age. And it's really sad to see children dying now from these preventable diseases because their parents refuse to vaccinate because they think the vaccinations will cause autism, which has been debunked. But anyway, we have a lot of people. There's not this biological urge, I think, these days to have children. A lot of people have children because, as I mentioned, a lot of children died. And then a lot of people had children, like 7 or 8 kids, because you needed more kids to work the farm, that sort of thing. So there's a lot of that happening. But we have now reached a point where there's not this as great of a biological urge to have children. I think this is just nature. The other thing is, what we've seen this with people having more difficulty having children. I think people are waiting longer because of cost of living, that sort of thing. Plus, what's the effect of like microplastics? I'm not sure if there's been any research done on this. Pretty shocked if there hasn't. But what is the effect of microplastics on fertility? Effect of microplastics, because microplastics are everywhere. What is it? There's like a gram of microplastics in everyone's brain on fertility. I just want to see if there's been any research done on this. Microplastics are a growing concern due to the potential impact on human health, including fertility, by disrupting the endocrine system and potentially causing. There we go. Maybe there has been some research done on this. Oh, there we go. National Institute of Health. Microplastics may be a significant cause of male infertility. There you go. Adverse effects of microplastics and nanoplastics. So we just don't realize how much of an effect microplastics has on us. But anyway, so my whole point about meaning of life is to procreate is just general. I'm talking about all life. I'm talking about that those species that are under threatened, that are on the precipice of becoming extinct. Their meaning of life is to procreate. That is the sole purpose of them being alive, is to keep their species going. For humans, I think it's changed. And that's why you have you and me maybe discussing what is the meaning of life. But ultimately, it's to procreate. If you take away everything, if you take away the amount of humans in the world, if there was like 200, a good example of this is any disaster show where something destroys most of humanity, what's the first thing they start talking about? Procreating and getting more children. First thing they talk about. What was that South Park episode where Cartman fooled Butters into thinking the world had, collapsed? There was a meteor strike, and he goes out and he finds this woman, Butters that is, and first thing he thinks about, well, we have to start having sex to procreate. Great episode, by the way. What episode was that? That's right. Carmen wanted to go to that Mexican restaurant, and one of his friends says, "Not you. I'm not going to invite you because you're an ass, and so I'm going to invite Butters instead." So to go to the restaurant, he had to kidnap Butters, not kidnap him, but fool him to thinking the world had come to an end or something like that. Put him into a bunker. A great story. Great episode of South Park. Anyway, and the funny thing is, it's a comedy show, and the first thing when Butters saw a female procreate, we have to keep the species going. But I think definitely you can have a philosophical discussion on what is the meaning of life. But I think we can do that because there's 8 billion people on the planet. So thank you, Forest Hill. And next we have platforms. This is multiple questions from Chris with 2 S's. 11.9. Is that 9.11 or 11.9? Hey, Kneppy, how do you keep track of your trades for tax purposes? Which trading platforms do you use? How did you learn to read charts? Love the content, by the way. Thank you. Okay, so this one, how do you keep track of your trades for tax purposes? You could use ShareSite. You could use, by the way, ShareSite. I won't log into it. You can use ShareSite. You can use, what's the other one? Navexa? Is it Navexa? What is it called? Oh, what's it called? I'm sorry, this company. There's another one. Site like ShareSite. I can't even spell share site. Alternatives, Navexa, that's it, Navexa. So you could use Navexa. So this is, see, Navexa Portfolio Tracker. Does all the work for you. Funny enough, Superhero, which I do trade, does a lot of the work for you as well, which I found last year. So that is how I track my portfolios for tax purposes. Which trading platforms do you use? So originally I started with ComSec, then ComSec didn't lower their prices, so I stopped using ComSec. I'm not going to pay $20 a trade. That's absolutely ridiculous. Then I went to Self-Wealth. That was that $10 a trade or $5? I can't remember now. And I still have some holdings in Self-Wealth, but I haven't traded through Self-Wealth for a few years because now I use Superhero and I only spend $2 per trade. It's great, $2 per trade. So that is what I use. Now, some people are turned off by Superhero because technically you don't own them. You don't have, what is called a HIN number or something like that, but it's fine, yeah. To me, it's a very low risk. How did you learn to read charts? Well, I started as a value investor, not really caring about charts, just looking at valuations of companies. And because I am curious and quite curious and open-minded, I think it's very important, I started to see, well, charts, it's interesting, these charts. And then I started learning about charts, started reading books, lots and lots of books on technical analysis. I did a video on that, all the books I read on technical analysis. And I'm going to show you right now. Books. Maybe I wrote books. See if I got it. Books I'm reading. No, there's definitely a video I've released in the past just talking about books. Technical books. Yeah, here it is. This one, May 18, 2024. Technical analysis books. There you go. May 18, 2024, technical analysis books. So those are some of the books I'm reading or have read. And that's how I really started to learn charts. It took a long time. It was a long process. And the most important thing was reading these books, understanding some concepts, and then seeing those concepts at work. And I still remember the day that happened. It was a company called M2 Communications, probably 2014-15. Share price of that company was going sideways. The valuation of the company, the P ratio was really low, like 12. I didn't understand why the share price wasn't rising. And then one day the share price rose about 5% on really good volume. I can't remember if it was a breakout on financial news. I just remember the share price broke out of this consolidation range. And I just thought, wow, okay, so this is a breakout, I think, based off technical analysis. I think I should buy. And I bought, and the share price kept on going up. It was an eye-opening experience, and you hear a lot of people saying, a lot of experts saying technical analysis doesn't work. This was a point when I realized, yeah, there's something to it. There is something to it. And I believe, significantly, I really believe the people who think technical analysis doesn't work haven't really put any effort into studying it or doing research in it, because if they did, they'll find that it does and can work. So hopefully I've answered some of your questions. Chris, let's have a look at 200-day moving average. Eats day traders for breakfast. Can you make a video with top 10 list of tickers that you would buy more during pullback to 200-day moving average? I'd probably do 200-week moving average. That is what I would look at. And if this is really simple, I might do a standalone video on this, but this is really simple. This is Amazon, Google, maybe not NVIDIA, Apple, Microsoft, maybe TSMC, maybe not Tesla, Facebook. So those are some of the companies in the United States, among many. Some of the companies in Australia would be, here we go. Some of the companies in Australia would be probably Pro Medicus. If we see Pro Medicus share price getting to the 200-week moving average, this would be the company I buy. And by the way, if you have a look at the 200-week moving average, that's at $111 right now. So a long way to go before we get to that level. REA Group, Telix, Technology 1. WiseTech maybe 0. What else? Supply Network is another one. I've already talked about that. Yeah, so there's quite a few companies. I'm giving you, or have given you, way more than 10. Way more than 10. So that some of those companies are what are the companies I'd be looking at for a 200-week moving average pullback. I'm looking for high quality companies. Wouldn't do that for every company, just high quality companies. So thank you for that, Eats D Traders for Breakfast. And I might do a standalone video on that since there are 4 likes. Well, there were 3 thumbs up, but now 4. Now on to Polynovo. This is from, who is this from? I don't know how to pronounce this. DG Ho Mean Garden. Hi Kneppy, what would be a good price to pay for Polynovo? Thanks. This is a difficult one. So Polynovo is profitable, I believe. Oh, I shouldn't have got rid of that one. FinChat. So Polynovo is just profitable. So it has a P ratio of 139.9. I don't think you can look at P ratio for this company because they have a really low profit. Let's have a look at the financials. They have a really low profit. So first thing I look for is revenue growth. So that's not an issue with Polynovo. Beautiful growth in revenue. But another thing is their profit. If we go down to, where is it? Profit. Here it is, net income. They have just become profitable. So $5 million of profit. This company could triple their profit in the next year. Definitely could do that, easily do that. So you can't really look at the P/E ratio because if you just look at the P/E ratio, you might say this company is stupidly expensive. And yeah, in isolation, maybe 139.9. But if they double their profit over the next 2 years, the forward-looking PE would be, what's that? 35, which is not too extreme for a company that is growing at a significant rate. So it's all based off the expected growth in this company. You can't do a DCF for this company. You cannot do a DCF for this company because you're going to get a massive range of valuations. You could get something between maybe $200 million to $5 billion, which is just useless for a DCF. So I think it all comes back to conviction around this company. How much growth do you think this company is going to get? And I can't really tell you. Can't tell you at all with this company. And since Polynovo, in my opinion, is not a high quality company just yet, it definitely has a potential. I think this is one of those companies that has the potential to be a high quality company in the next decade. I wouldn't say it's just there yet. It already has a market cap of almost $1 billion. So there's a lot of promise already built into the share price and valuation of this company. You just look at the revenue growth. I've talked about revenue growing at between 40 and 50% over the last 5 years. So significant growth in revenue over that period of time. And we need to see revenue keep on growing. Now, what I would do with Polynovo is just have a look at the chart. We've also seen a bit of board and CEO jousting. Is that the right word? I was going to say confliction. Friction, that's the word I was thinking about. Now, if you have a look at the chart, this is the weekly chart, nothing to like just yet. Now, if the share price got to say below $1, I might be a little bit more interested just because of where the share price has dropped to. Now, if you have a look at the one or the daily chart, this is an ugly looking chart. I would also say that there is definitely some argument that this company is oversold. So if you just have a look at RSI, definitely oversold. Yeah, it's been oversold for a while. It's been oversold for about 3 weeks. And the share price keeps on falling, even though it's oversold. And yeah, the chart just looks horrible at this point in time for Polynovo. So that's the way I would do it with Polynovo. Definitely a company I have on my watch list. Definitely a company I might trade, but not a trade right now. And definitely a company I might buy for the longer term in the future. So I think it all comes back to your conviction. But I did mention $1. If I did see the share price drop below $1, that would be an interesting level for me. But it could keep on dropping. But again, it could keep on dropping. It could go from $1 to 50 cents just because there's already a lot of promise already priced into the company's valuation. So hopefully that have helped. So I would say your conviction is going to be different than mine. Next on the list is from a Joshua. Whenever I see the word Joshua, I just think of War Games, 1984, Matthew Broderick. I'm pretty sure the machine in War Games was called Joshua. Definitely the son. Anyway, for those who don't know what I'm talking about, War Games, Joshua. Yeah, that's right. Stephen Falcon developed Joshua, and with on precipice. Well, not we in the video or the movie, the world was on the precipice of nuclear war. Pretty good movie. Now, I probably like this movie because this was in my youth when I was really, really young. Oh, 1983, I was missed it by 1 year. Anyway, so whenever I see the word Joshua, I just think of that movie. Anyway, so back to Joshua 0689. He's a relatively new investor, looking to become a bit smarter and more proficient in how I invest. I've been enjoying your videos in your approach. How do you set your buy and sell points? Do you set them to be automatic, or do you review all your trading positions semi-regularly and sell manually? Absolutely. I have no automatic stop losses. So I never have any price targets, never have targets, and then sell at that target. I think that's ridiculous, because if the share price reached that target, the share price is in a beautiful uptrend. Why would you want to sell if the share price of a company is in an uptrend? Absolutely not. So I don't have automatic stop losses. I did use them one point, and I thought, no, I'm just going to do it not automatically, manually. And I look at all my trading charts every single trading day. So I do have a watch list here of all the companies I'm trading, and I go through all these charts every day. And when I see weakness, I might follow them a little bit more closely. For instance, what's something that's looking weak now? Which one is the weakest here? Let's have a look at Life 360. This is interesting. I wouldn't say this is weak. So I do have a sell price at $21, and the share price of Life 360 is at $21. Because we've seen overall weakness in tech companies, we've seen a little bit of weakness in Life 360. They released a pretty good quarterly result not that long ago, but the share price hasn't really taken off because of overall weakness in the market. So this is one where it does look like maybe the share price and the trend is starting to shift. Maybe, but I'm not at the point where I'm going to sell right yet. Whenever the share price does drop below $21, we see a little bit of rally. It's happened 3 times in the past 3 or 4 months. So that does seem like a good price. Now, just because the share price might close below $21 tomorrow, not tomorrow because tomorrow's Sunday, on Monday or Tuesday, doesn't mean I'm going to automatically sell. I might just give it a little bit of time. By the way, it won't drop below $21 because we're going to see a pretty good day on Monday. We should, because NASDAQ's up 2.5%. So we should see a really good day for Life 360. I wouldn't be surprised to see Life 360 up 5% or something like that. By the way, let's have a look. So NVIDIA up 5%, Shopify up 4.7%. Micron up 6%, CrowdStrike up 6.4%. Yeah, so a nice little bounce for some of these American tech companies. Hopefully I've answered your question. Yeah, so it's all about, what's happened there? Cancel. It's all about, it's nothing, I do nothing automatically. I'm just talking about sells. When it comes to buys, that can be a little bit different. It's a little bit different when it comes to sells or buys, I mean. So hopefully I have answered your question. Now on to Rick Thelion. Oh, Rick Thelion has it wasn't a question, it was more a bit of a comment in regards to something a lot of people don't think about when it comes to tariffs. So iPhone 14 made in China was costing Apple $10 with a tariff of 25%. Apple paid $12.50. How much would an iPhone sold for in USA? Apple won't be making their products in USA. They just add $100 on top to consumer, making another $97.50 in profit in this example. The whole reason this is a really interesting comment is because a lot of the manufacturers in the United States do import a lot of the stuff they manufacture the stuff with. And if that costs more money, they're going to raise their prices. So there's this second or third order thinking you need to have when you consider tariffs. And we have already seen companies leaving the United States, moving their manufacturing to other countries because of that increased input costs. We saw on the ASX a company called Austin Engineering. Austin Engineering say exactly this. They are moving their production from the United States to Canada because it's going to be cheaper for them to do that. When did they say this? They said this in, trying to remember when they said this. Here we go. Austin's US business shielded from US tariff impacts. I'm wondering if it's this one. And they just mentioned this. So they're going to keep some of the manufacturing in the United States. And the reason they're doing that is because they're selling in the United States. But the rest of their manufacturing, they're moving to Canada because it's going to be cheaper. Because input costs in Canada are going to be lower because there's no tariffs on the imports. In fact, yeah, they've mentioned here. Yeah, here, in fact, they say here, in the last 9 months, Austin completed a repositioning of its US business to ensure it would not be directly affected by tariffs imposed on goods imported from Mexico or exports from the US to Canada if Canada was to enforce its own tariffs in response. This has primarily included the development of a new truck tray sub-assembly supply chain route using Canadian contractors, has undertaken a final assembly builds in Canada for several years. So they've transitioned from not all the manufacturing, but some manufacturing from the United States to Canada because there's less import costs in Canada because of tariffs. Yeah, so a lot of people, you have to understand there's second or third order impacts of increasing tariffs. And that's why there could be a significant increase in the costs for consumers in the United States because everything's going to be increasing. There's going to be very few companies who could build their products in America just by using American imports. It's going to be an almost impossibility. So thank you for that comment, Rick Thelian. Great comment from Rick. Okay, so let's talk about next one on the list is, this is the one where it makes me think. And this is from Thorley Photography. What if Thorley Photography is really into photography? Anyway, so that'd be really good. I wonder if he has shows or anything like that. Thank you, with P for the O, for another thoughtful and detailed video. Today was different. Was spelled with 2 A's, but we're not here to mark you on your spelling. We know what you mean. That's the most important thing. We know what you mean. All the private credit funds pulled back. I don't follow any private credit funds at all, and not interested at all. And in fact, he said this. I have never seen this before, especially MXT, which is metric something income, metrics master income trust. That's what it is. Back to the comment. So never seen the share price pulled back. Never seen this before on no news. I know it's not your jam, but I thought it was unusual enough to merit discussion. So here we are. Okay. So what I did is have a look at Metrics Master Income Trusts. Share price the other day dropped 4.6%. It's like, that's sort of interesting. But you notice the share price doesn't move all that much from day to day. Slight increase, slight decrease from day to day. So then I had a look at the chart, and this is when it really intrigued me. So share price of this just goes sideways. Well, I suppose you could say a gradual increase over time. Although if you have a look at the weekly chart, it doesn't change at all. So this is truly an income stock. Income stock, it's in the name, income trust. This is a sort of an asset where the capital won't grow. Best time to buy this asset is when the price fell significantly during COVID-19. It would have been a good time to buy, by the way. But then for some reason, this happened twice now. So for some reason, the share price dropped significantly on that day, which is unusual. Some really big volume coming in, by the way. In fact, let's go back to this. Yeah, some really big volume came in, not only on the 12th, but also the next day. So in fact, the highest volume was the next day. I'm not sure what that was, but we also saw this, it looks like, back in 2022. Yeah, so during the yen carry, no, that wasn't the yen carry trade. No, wait there, here it is. So this was a massive decrease. Remember, there was a massive pullback in the market back in June 2022. And we saw the same thing happen with Metrics Master Income Trust, and then it rebounded almost instantly. So that was a good time to buy. I have no idea what happened. No idea at all what happened with private credit funds. I tried to Google it. News. Melbourne private lender spooks fund gating redemptions. Private credit is booming, but one trend is troubling. It's really interesting because I saw this comment about private credit funds, and in the last week, I have deleted 2 podcasts that were completely devoted to this topic, private credit funds. I just deleted it. I don't really care about private credit funds. So I'm intrigued what's happening here. Yeah, private credit is booming. Private credit markets continue to expand. Major ASIC reports warn of future private credit failures. So I'm going to have to do a little bit more research in this space, just because of this little comment from Thorley Photography, something that is outside of my comfort zone. But I'm just going to explore this space a little bit more now because of your suggestion. Thank you, Thorley Photography. But I can't answer anything about this. I have no idea. I have no idea what happened. Maybe there's a little bit more fear in there. By the way, Jerry Shen, look at that, Jerry Shen, 11 days ago. What are your thoughts on listed private estate, private credit funds like QRI or MXT? I think I did answer this. Yeah, I wasn't that interested. So QRI, is this another one? Let's have a look. QRI, real estate, did this have the same sell down? Not quite. Maybe it's a little bit different. I have no idea. Thank you for that, Thorley Photography. Now on to a comment from AU5657 in regards to the ASX performance. ASX is now the worst performing index globally in weekly, monthly performance together with NZX. Even Canada, TSX, and Mexico have done way better than us. It seems like foreign money is constantly cashing out our market for whatever reason. This is something I also noticed. Now, when you say globally, I'm assuming you are ignoring the American market. So let's have a look. And we can do this, a very quick look. So the XJO did pull back over 10%. So we definitely saw a correction with the XJO down 10%. In fact, the banks in Australia down, it was about 15%. Oh, it's even more now. So the banking sector down 15.5%. That would be a significant driver to why our indices are down, because the banks were significantly overvalued. I'm not sure that would be true for Canada, but definitely it is true for us. You can even see it in the XTO, which is the ASX 20. The ASX 20 down 11%. So the bigger companies in Australia are or have been really weak. And I'm just wondering if this has been led by the banks, mostly the banks. The mining sector, what's the mining sector? In fact, let's go have a look at this. Market index, sectors, or indices, maybe. Let's have a look at the week. So gold's had a really good week. In fact, if you have a look at the month, so gold's had a really good month. Resources down 6%, but tech's down 15.3%, banks down 14.8%, and ASX 20 down 10%. So the weakest indices on the ASX have been those big companies and tech. Tech, I understand because of NASDAQ. So a lot of the weakness, I think, in our indices or our market is the banks. And we've been discussing this and talking about this over the last few months. The banks are overvalued, particularly CBA, really overvalued. And we're starting to see a little bit of weakness. And maybe there's a bit of a rotation out of the banks into maybe some of the big global funds are taking the money out of the Australian banks into other markets. I don't know. Maybe that's what's happening. Canada, in fact, I very rarely look at Canada. So let's have a look at the TSX. What's the pullback in the TSX? Let's have a look. Doesn't look anywhere near as bad. So the pullback in the TSX was 6.3%. So it's still pulled back, but it's not as much as the Australian market. What about the DAX? Yeah, no pullback in the DAX. And this has been led by one company, really. And the FTSE, There has been a slight pullback, but nothing too extreme. What's the Mexico exchange? I have no idea. Since you've mentioned it, Mexico Stock Exchange. Is it the MZX? What's the ticker code? BMV. BMV, there you go. Oh, Bolsa Mexicana del Valor. Of course, they don't speak English there, so Mexico Stock Exchange doesn't even make sense. BMV, let's have a look at the BMV. Is it even here? I don't know. It should be in the indices. Let's have a look. Here we go. And to be honest with you, the BMV looks crap. This looks crap. This is daily chart. It looks pretty crap. Anyway, so unlike the Australian and American indices, who were in uptrends, and Canadian indices as well, this is trendless. This is trendless. Anyway, so that's my thoughts when it comes to the performance. Banks have been a deterrence on us. Tech as well, that has pulled back a fair bit. And I think money has been rotated out of the banks into maybe the miners and maybe companies in other industries around the world. I don't know. So anyway, thank you for that. Now on to crossover. Oh, this is about how to set up a crossover. This is from the Rodster. Can you please show how you add the two different moving average indicators with crossovers on TradingView? I've done this before in a video, but why not do it again? Why not do it again? So we do have this crossover. So two moving averages with a crossover. And what I've done here is I've got an EMA cross 25 to 100. It's actually, if you can find it, indicators. Here it is. So you have a lot of crossovers. So I think I use the EMA cross 50 to 200. And then what I did is I changed the in-point editor. I think you can do it here. Yep, in-point editor. I changed it from whatever it is, 50 to 200. And I just changed it to 20 and 100. So in fact, what I'll do is, so what you can do, if you include that particular indicator, you can go to settings. Where is it? It's source code. Go to source code, and here's my source code. And what I did was I just changed the 25, so the short and long, to 25 and 100. The other thing I did is I made the cross, which is a crossover, a little bit bigger because it is smaller. So if we have a look at this particular indicator, let's put it in, and I'll get rid of what I've got. Yeah, this is the indicator. You have that EMA cross 50 to 200. You can see the crossover is fairly small. It's also in blue. And I've also made the lines bigger, the moving averages bigger. So that's the only change I made. So you can actually change a crossover to whatever you want. So you can make it 50 to 100, or you can leave it like this. You can make it 10, 25, 5, 50. And then, yeah, make sure you learn how to point edit or edit these scripts. And then you just save it to whatever you want. So hopefully I have made that clear in this video. Thank you, the Rodster. Thank you. Next one is Kinatico. I think it's called Kinatico. P. Mahajan Good. What's your thoughts on Kinatico? KYP. I think this is Kinatico. Kinatico. Yeah, it is Kinatico. This used to be called. Oh, this used to be called. Oh, it used to be called. Oh, it used to be called something else, and they changed the name. And whatever they used to be called, it was pretty obvious what they did. It was in the name what they did. And what I'm going to do is just go back through. Yeah, credit CV1. CV1. CV check. Yes, CV check. CV1. They changed the name from CV Check CV1 to Kinatico. Now you have no idea what they do just by the name. Before you knew exactly what they did. CV checks. Anyway, this company, what I'm going to do is open up, if I can, their Appendix 4C history, and it's taken a while, Microsoft Excel, to open. I have been following this company for a long time, maybe 8 years, maybe. And this company has always been on the precipice of really expanding their operating cash flow and free cash flow, and they've never really reached that point. And I'm talking about maybe 6 or 7 years ago, I thought, oh, this company is reaching that point. It reminded me, just their cash flow or receipts growth and operating cash flow, free cash flow, reminded me of my net phone going back 15 years ago. There's another company that reminds me of my net phone right now, and that is 5GG, which I've taken a position in because it just reminds me of not the company itself, but what I'm seeing, the pattern. Anyway, so for some reason this is taking ages. I've got to open up investing. And I'm just going to show you the cash receipts history of this company going back, I'm going to say, maybe not 10 years, maybe 8 years. For some reason, this is taking ages to open up. Here we go. There we go. It's trying. It's trying. I think I might need a new computer. Oh, this computer's getting old. And I'm just going to show Guru Focus. For some reason, I've got Guru Focus there. KYP. So I've been following this company since 2015. They no longer issue Appendix 4Cs, but their growth in receipts really reminded me of that company I was talking about before, MyNetPhone. I'm going to show you their growth in receipts. And I do like this sort of growth in receipts. This was over a period of time, period of about 8 years. You can just see me doing, and they stopped issuing Appendix 4Cs in April 2023. It's not that long ago. And the reason they did that is they were probably operating cash flow positive about probably 4 quarters in a row. Gotta get rid of you. So let's just have a look at this particular chart. I don't have to do it in a really good chart, but I just want to show you this. Here we go. This is it. So this is the growth in receipts over an 8-year period. Now they must have made some sort of acquisition back in July 2021, but this is what I like to see. So growth in receipts, nice gradual growth apart from one acquisition, and then the companies stopped giving Appendix 4Cs because they became profitable. So you can have a look at the most recent results, half-year report and accounts, and I'm assuming the company was profitable and cash flow positive, which is exciting. All they need to show is they can leverage that and keep on growing the revenue, but grow their profits and their cash flow at a greater rate than the revenue. If they do get to that point, that would be really exciting. Now, I'm not sure what this company does anymore. I'm pretty sure they're on the same, they'd probably changed the name because they pivoted slightly. You can have a look at their About section here. No, they don't have it. Were they profitable? Yes, they were profitable. Slightly, $516,000 in profit, but it's a growth. So I just need to see a little bit more traction in the business for this company. A little bit more growth, I suppose, is the best way to say it. Now, let's have a look at the chart for this particular company. KYP. You have to go to stocks. Actually, we'll go to all. Got to get rid of that. There we go. The first thing is, looks like there is a little bit of liquidity issues, probably not big issues, but the chart is in a nice little uptrend. I want to see a little bit of increase in volume. We've sort of seen a subtle increase in volume recently, say over the last 9 months, but I want to see a little bit of a better increase in volume. If you have a look at the weekly chart for this company, So even though I've been following this company since 2015, you can see share price has really done nothing in the last 7-8 years. It's done nothing. You could say it's in a little bit of an uptrend now, just based off the weekly chart. You could definitely argue that, but I need to see a little bit more from the company's financial performance. And if we do see that, I think that will reflect in the chart. Not the worst company by far, but not a company I'm following too closely at this point in time. Now, the last two questions I'm going to have, not you, Antonio, because you are a spam. The last two questions have just been put onto my videos in the last hour since I recorded this video. Well, actually, before I started recording the video. From Dev Shaw. Hey, Kneppy, thanks for these daily videos. Very informative. Why Mesoblast is dropping, gone down almost 30% in just last month alone. Has it anything to do with the company not being profitable in foreseeable future? Back in December, when they announced FDA approval for Ryosil, the stock price went up 200%. Any updates on Mesoblast? Let's do a quick update on Mesoblast. Now, for full disclosure purposes, I had been trading this. I'm no longer trading. And I think the main reason share price has dropped is just overall negative sentiment in the market. The share price has dropped a little bit too far for my liking. Now, maybe $2 will be a good price to buy. The reason I say that is before they released that FDA approval, share price popped up, and the share price before that day was $2, and we've just seen the share price bounce off $2. I would say just now, based off the chart, $2 is a good price to pay for this company. If the share price drops below $2, that could be a good, price. It's sort of like a low risk trade. You buy about $2 or just above $2. Share price drops below $2, sell. Significantly fall below. When I say significantly, say to $1.90. But this could be the bounce. Maybe we're going to see a bounce from Mesoblast. Wouldn't be surprised to see it oversold. And if we do see a really good bounce in the market, and if this correction is now over, there's a chance it's over, this could be a good time to buy some Mesoblast. So I think it's just some profit taking, also weakness in the market, and now could be a good time to buy. So I don't think there's been any updates. So any updates? I can't remember. Yeah, so they did release this Ryosil pricing set and available this quarter. I thought that was pretty good. And then their half-year results also on the 27th of February. But nothing, no news flow to justify the decrease in the share price. So I think it's just sentiment, short-term sentiment in the overall market. And I think a little bit of profit taking as well. And now could be a good time to buy Mesoblast. In fact, I'm going to put on my buy. I'm going to put on my buy list. I might put a sneaky buy in for Mesoblast. And finally, Simon PT 2000. Kneppy, do you think it is likely that there will be some sort of resolution before 2nd of April, which is when the reciprocal tariff policy will take effect? If yes, we might see a decent bounce in the market. Yes, I think it's definitely a possibility. I think even though I sort of laid into that guy who said Trump is just using tariffs as a negotiation tactic, I think it's a possibility he's still using tariffs as a negotiating tactic. But at this point in time, he's losing. Now, the rest of the world is fighting back, and I think they are winning at this point in time. And I'm not sure how he's going to move forward with this, because they are losing at this. In my opinion, they are losing. Reciprocal tariffs, I think he could be really proud, and maybe because they're losing. In fact, he's even mentioned he's really peed off that they're all fighting back. And this has been a problem when it comes to tariffs in America. We saw this in 1930. Countries fought back, and they were surprised. They were surprised that there was this fight back. They didn't think countries would retaliate. We saw this in 2018. In fact, I forget who it was. Someone said when they had that initial wave of tariffs, we don't think countries will retaliate. And even now, I think they're surprised at how much countries are retaliating. I think they thought countries would just take it up the backside, sort of like what Australia's doing right now. Anyway, so I think there's definitely going to be some sort of resolution. But in the back of my mind is this thought that Trump truly believes that tariffs are a good thing. And that is a really horrifying thing to think. that if he really believes tariffs is a way moving forward, they've even mentioned that they're going to get rid of income taxes for anyone earning less than $100,000, and they believe they're going to fund that through tariffs. But who pays the tariffs? The American consumer. So it's not really a tax decrease. But there was some also read somewhere where if that really happened, they'd have to increase or put 400% tariffs on everything. 400% tariffs on everything to decrease or to get rid of the income tax. But they also mentioned that have to balance the books, balance the budget before they would think about introducing this getting rid of income taxes. And he's not going to balance the books. He's not going to balance the budget. There is no way Trump is going to balance a budget. In fact, the trade deficit, or not a trade deficit, but the budget deficit is going to significantly increase because of Trump. Anyway, so I think it's definitely a possibility, but I'm not banking on it. I'm not going to bank on it. And we did see this in 2000 and let's go to the X or NASDAQ. We saw this in 2018. Why did the markets crash in 2018? Let's go back to 2018. Do you remember the markets crashing in 2018? In fact, the NASDAQ dropped. The NASDAQ dropped 23%. Why? Okay, I've always thought this was because of the Fed saying they were going to increase interest rates. Now I've been reading that this was because of tariffs. And then the threat of tariffs started to wane back in late 2018, early 2019. And that's one of the reasons why the stock market started going up, because the threat of tariffs was no longer there. So this is what could happen if we get more threats of tariffs. And if we don't see this resolved, we could see the market drop even more. Okay, that's all I have for this video. If you have any questions, any thoughts, leave those in the comment section of this video. By the way, Simon PT 2000 publicly subscribed for 4 years. Anyway, that's all I have for this particular video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.